This lady is telling you that you could pay your mortgage off in 77 months by using a line of credit. What if I told you there is a secret that is even more simplistic to pay off your first mortgage even quicker?
Today we're going to be discussing how the banks are sucking the life out of your finances.
Sucking the life out of you.
Today you have a choice. You are choosing to throw your money out the window if you continue doing what I'm about to speak on in this video. It's your choice.
Look at the passion that she has, that this is going to save you a ton of money and that you've been so dumb to throw your money out the window so someone else gets your money as opposed to the bank.
They have purchased a home. The purchase price was $150,000. They put down $15,000, which left them a balance of $135,000. Then, of course, they got a mortgage because that's what they tell us to do. You want a home? Get a mortgage.
So if you're in the position where you own a home, you may be living paycheck to paycheck, but you're not necessarily broke. She says $15,000 on a $150,000 purchase. That's not necessarily living paycheck to paycheck per se.
So they started their payments this month, December 1st, 2023.
Oh, it's 2023. Okay. I didn't even pay attention to that part of this because I'm so confused by all of the numbers that she has listed here initially. It's quite overwhelming.
7.75%. Guys, if you're in these ridiculous interest rates, I don't care if it was going on in the 80s or not. It's going on right now. If you didn't have the knowledge in the 1980s and you went ahead and you paid this ridiculous interest, then I'm sorry. It was only because you weren't taught the truth. This video is going to teach you the truth about what that 7.75 interest rate means to you.
And this is the thing, interest rates are very important, right? It dictates how much you pay in your monthly payment, how much interest you pay over the life of your loan. There's always a reason and like a pitch to why people do these types of videos, because why would we not just traditionally go the route of paying the mortgage down, maybe prepaying the loan, and we'll go over that, than to do this like elaborate line of credit thing. And she's gonna get a little more in depth. We're gonna fast forward a little bit here.
Month 2. Balance, $134,905. Monthly payment, $967.16. Interest, $871.26. Principal payment, what actually went to the house that they're paying for? $95.90. How long do you think it's going to take them to pay this home off, paying these small little payments towards their actual principal amount? 30 years.
Duh! It's a 30-year loan. So 30-year loans are always front heavy on interest, typically for like the first 10 years. The reason for it is having a lower monthly payment. 30-year just happens to be kind of the industry standard because it's the most comfortable payment. There's no prepayment penalties, so you have the flexibility.
We also discussed that they have $1,100 in cash flow every month.
This is really important. It always has fixed numbers on a monthly basis when it boils down to your income, your mortgage payment, which includes your taxes and insurance, and your monthly expenses. And the reason why those are fixed is because she comes to this final number that says cash flow, $1,100. That $1,100 is going to pass through the line of credit and prepay the mortgage off.
So according to the amortization schedule, a $10,000 chunk on this $135,000 mortgage brings it down to $125,000, but it skips from December 2023 all the way to July of 2030.
This seems like a really convoluted way to pay your mortgage off in a shorter period of time than just go directly to taking that $1,100 cash flow or any extra money you have on a monthly basis and just putting it towards the principal balance of the loan. All right, so let me prove it to you. This is a calculator through bankrate.com. So I have a 30-year loan that has 30 years remaining on it, $135,000 original mortgage amount, and I just entered in additional monthly payment of $1,100, which is the cash flow that she's referring to. That cash flow is going to change because life changes. I also put in an interest rate of 7.75 because that was the rate that she mentioned on the primary mortgage. I hit calculate, and what it says is that mortgage repayment is shortened by 22 years and 10 months, and you save $172,000 in interest. So if you have a 30-year loan and you shorten it by 22 years and 10 months, you're almost around the same time frame that she's saying to have this paid off. All I did is I just took $1,100 every month, which was my cash flow, my extra money, and put it towards the principal balance of my loan. And by doing that, that saved me almost 23 years. Why would I not do that than to do the line of credit? It just doesn't make sense to me, right? Because you're taking out another loan to pay for a loan and then you're paying that loan back to pay the other loan back, when it's like, why not just pay extra on the original loan? That $1,100 is a missed opportunity to invest and make money. So you could take that $1,100 every month and invest it in something. That $1,100 you put in every month is going to compound, and that's going to grow your wealth, and now you have liquidity. My whole thing is home equity lines of credit, or lines of credit in general, different from a mortgage, are recorded on your credit as a revolving line of credit. I just think if you take your hard-earned money and you want to pay your mortgage off, just pay extra. Use a calculator from my website down below in the description, and you could just click it. You go to resources, calculators. What happens if I pay an extra payment? You'll see. It's that simple. Don't make life overly complicated. Invest money, grow wealth, pass it on to your kids or future generations, and live happy. So maybe you watch this and you're like, Fernando, what the heck? I don't have $1,100 a month in extra cash flow. I only make $60,000 a year. I got you covered. Check out this video and I answer all your questions.